welcome. You're watching Business Today TV. I'm Sakshi Batra and this is a special edition where our focus is on the IPO space, especially of the company Awfis Space Solutions. It's the day 3 of this IPO subscription. The company plans to raise 598.9 crores from this issue, which is a combination of both fresh issue of 33 lakhs, aggregating to about 128 crores, and an offer for sale of 1.23 crore shares worth about 470 odd crore rupees. Now, Awfis Space Solutions has fixed the price band at 364 to 383 rupees per share, and the lot size is 39. And already on the third day so far, we've already seen that the company has got over 5 times of the subscription, and the retail portion has overbooked by over 15 times already. Joining us to detail for us what the company's vision is post listing, I'm now joined by the top management of the company. Amit Ramani joins in. He's the chairman and the managing director of Awfis Space Solutions. Warm welcome to you, sir. Thank you so much for taking the time out for this discussion. First up, congratulations to you. Strong demand for your IPO already. You've got oversubscriptions and all the 3 segments have actually got very good demand for you. Before I come to what are the proceeds really going to help you do going forward from here, first up, to help all our wider audience really understand what your company really does, because it's a unique company that's going to be listing on the stock exchanges, a first of its kind as well. Awfis, with the name of it, you've played around with the names, but of course it sounds like an office that we all go to on an everyday space, and therefore there is a linkage to that space. But I will throw the mic to you to tell us what is the company's story all about thus far, and what does the company do?
Firstly, Sakshi, so much thank you for having me on this show. Greatly appreciate it. As you said, obviously, we have gotten some very good response. So let me talk a little bit about the business, and then, what kind of sets us apart. So when we started the business, Sakshi, we were solving a very key need in the market, which was the ability to find quality infrastructure at an affordable price. And as you know, when we look deeper, the demand ecosystem was actually looking for 3 things that we needed to solve. One was flexibility. The customer should choose 1 day or 5 years, 1 seat or 500 seats. Second was accessibility. Growth and infrastructure in this country was not keeping pace. As a result, commute times are increasing and people wanted space which would be closer to their homes. Hence, the network becomes very, very important. And the third was ease of use. Somebody taking 20, 30, 50 seats should be able to get that at a very, very easy way versus having to find the space, design the space, project manage, and then finally manage the space. So I think these were 3 things: accessibility, ease of use, and flexibility, which we were solving for. But the interesting story was on the supply side of the ecosystem. On the supply side, if you really looked at the Indian commercial real estate market, unlike the global markets where almost 90% of it is controlled by institutional landlords, only about 25% in this country is controlled by institutional landlord when it comes to commercial real estate. Almost 75% is with HNIs, family offices, and tier 2 developers. And we felt there's an opportunity to partner with them because they're underrepresented when it comes to their marketing and leasing teams being there. And as a result, we felt the partnership model, which we christened as managed aggregation, became kind of our hallmark. And we were approaching these landlords, asking them to invest majority of the capital towards the new fit out of the space. We were also requesting them minimum guarantee free period, because a co-working space takes up a while to bring in the occupancy. And with this model, we were solving 2 problems. One, we became asset light. So essentially, our landlord partners were investing the capital. And second was we were mitigating the demand and supply mismatch, which was the biggest challenge in this co-working industry. And with that, we were solving 2 areas. Then coming to our business, so we started off in the co-working space. Today, our centers are typically about 30,000 odd square feet, 500 to 600 odd seats. It would have customers ranging from somebody taking 10 seats to somebody taking 200 seats. 10 to 25 customers coexist in that space. Second, because we expanded our network, we have 169 centers today. 16 cities, 52 micro markets, 105,000 seats today are with us. So with that, we are able to offer mobility solutions, which would be a meeting room for an hour, or let's say a seat for a day, virtual office solutions. We also, post-COVID, saw large enterprises coming into co-working in a big way. And as a result, we started taking up centers which are dedicated centers for large customers as part of our Office Enterprise Solutions. Then we understood that our customers take maybe seats or space from us, but they also do it on their own, right? In a conventional format where they rent the space and manage the space on their own. So we started offering design and build solutions for our customers. And then finally, we understood it's a services business. So we insourced all of the facility management, guard, housekeeping, pantry services in-house. So there are 2,500 plus team members that are there which deliver the service. So if you look at our platform, it's a truly a integrated workplace solutions platform that delivers one seat to 1,000 seats, one day to 5 years. We can design, we can build, we can maintain, we can operate
Okay.
all under one umbrella.
Okay. So, Amit, do tell us now, since 470 crore rupees will be via OFS and 128 crore rupees via the fresh issue, how are you planning to use the fresh issue proceeds? First up, second up, who are your selling shareholders? What happens to the promoter shareholding thereafter?
Sure. So, Sakshi, we are raising 128 crores in fresh issue. 42 crores is towards the capex that'll go into the centers. So we have outlined about 12 centers with this capital, and 8 of those are in managed aggregation model, and about 4 are in a straight lease model. Second, about 50 odd crores is towards our investment for the working capital that we need. I explained the design and build business in which customers take up their own space, ask us to design and build it for them. That requires working capital. So 50 odd crores is going towards that. And the remaining is general corporate expenses. The other side, as you mentioned, 1.23 lakh to 1.23 crore shares are being sold. 66 lakh shares are being sold. 15 Sequoia, which has also taken on a promoter tag. The second piece is 55 lakh shares are being sold by Link and BISC, which are ChrysCapital companies. In this scenario, post the selling shareholders, Peak 15 will still have about 10 to 11% in the company. Sequoia will, ChrysCapital will still have about 13 to 14%. I'm not selling anything. So post the listing, I would have approximately 17% of the shareholding, and rest are held by Mr. Ashish Kacholia, who was holds about 5% and probably 4.5 post listing. And then there are 4 large family offices which pre-listing have about 26%, post-listing somewhere around 23, 24%. This is the Dalmia Bharat, this is Havells Family Office, SRF, and Jubilant Family Offices.
Okay, fair enough. Now, let's come down to understanding your financials as well. As of FY23, you crossed about 566 odd crore rupees. Then in FY24, up until 9 months, you had about 600 crores. But still on the bottom line, there is a gap. How do you see things progressing for you? By when do you see break even coming in for you?
So, Sakshi, I think, I would give you a bit of, historic to give you a context of where we are. 75% revenue growth CAGR across FY21 to December 23.
Okay.
In terms of our seat capacity, our chargeable area, our number of centers, number of micro markets, 40 to 50% growth across FY21 to December 23. The business has grown. You mentioned revenue for FY23. If you look at even our EBITDA number, that has grown. It's for the 9 month period. It is 195 crores. The important metric, though, is the cash EBIT, which is 67 crores for the 9 month period. If you look at our losses, which was negative 20% in FY21, is negative 3% for the 9-month period. And in absolute numbers, it's about 18 crores. So we are progressing towards profitability. Clearly, a first principles business. We have been EBITDA positive since FY21. Very, very healthy balance sheet. We are a net debt-free company. There is almost no debt. In fact, there is cash in the bank, positive almost 60 plus crores after the debt. We are very well situated as a first principles business. I can't comment specifically on the future results or specifics on when exactly we will turn profitable, but all the indications that you can see as per our financials give you that general sense on where we are headed.
Okay.
Clearly, yeah, right, Sakshi.
On your margins, sir, EBITDA margins, I think about in FY21, they were at around 40-42 odd percent odd. They've gradually come down to about 30-31 odd percent. Where do you see the trajectory headed for FY25? What is the sustainable band of margins you're looking at?
So, Sakshi, that 42% was an anomaly because we went from Indian GAAP accounting system to the Ind AS system, which is what we are required as a publicly listed company. If you look at the last 3 years, even the December 23, we are in the average of about 31 to 32% EBITDA margin. As the business scales up, as operating efficiency comes in, as operating leverage kicks in, these margins will improve. I can't comment on exact numbers, but directionally, we see obviously these numbers improving. The FY21 was a pure anomaly because of the accounting standards.
Okay. So also give us now a sense, little bit idea as to, what is the kind of rental fee you take per seat, how much cost you have to incur, but how much do you get in return, just to be able to do the math and to understand for you how things will progress per seat.
Sure. So, without going into per seat cost specifically, I would use an example of, let's say, 100 rupees a cost of a seat, right? Out of that, about 25% is operating expense, which is a combination of four things. It is consumables, utility, and manpower. A portion of that 25% is also towards common area maintenance. Now, post covering that, now if we have two models, Sakshi, as I mentioned, managed aggregation and straight lease. If I was to look at the straight lease model,
Yeah.
typically 40%, or in this example, about 40 rupees is the straight rental piece, right? So typically one would have to get to 65% occupancy in a straight lease for us to be able to make the first profit on that center, right? So typically, if you were to look at a blended occupancy of 12 months or more, centers that have been operational 12 months or more, it's 83%. Blended across our portfolio, it is about 71%. So in the straight lease model, at 65%, we make the first penny. In the managed aggregation model, 25% remains the same. 40, typically, the minimum guarantee is about 50% of the micro market rental. And so you add about roughly $20 because typically 40% was the straight rental. This would be about 20%. So at 45% in managed aggregation, we will start making money. In 45% of our managed aggregation centers, there is no minimum guarantee, which means that at 25%, I start making money for me and my landlord partner. So clearly a very, very differentiated model. And that's why today 66% of our portfolio is in managed aggregation and clearly mitigates the risk for the business.
Okay. What is the current occupancy that you are sitting on right now, sir? And what is the
Yeah.
visibility going forward from here, since you are now going to be building much more, 12 more centers you're talking about, which, is going to be used with this proceeds that you've garnered, about 42 odd crore rupees you're talking about. What is the visibility?
Yeah. So, Sakshi, we will build 45 new centers this year. 12 are from the proceeds we are raising as part of the IPO. Right. So 45 is the visibility, about 30 odd thousand seats we will add this year. Now, coming to the occupancy question, as I mentioned, today the blended occupancy, which is a center 1 month old to center since inception, is 71%. And if I was to look at centers which are operational for 12 months or more, this is 83%. And if I was to give you another example of fiscal 22, any center that we added, we got to 80% occupancy within the first 7.5 months of our operations. So we are very strong in terms of bringing demand. The growth, as you can see, the revenue growth, the seat growth over the last few years, it's all part of the RHP today. And we believe that we can continue to maintain these levels of occupancy going forward as well.
Okay. So you said that you are already present in about 16 cities. Now these 12 new centers that you're talking about, will these be in the same cities or are you going to be expanding further?
So, Sakshi, we have clearly outlined three new cities for our forward look, which is Vijayawada, Guwahati, and Lucknow. So, 19 total cities, 9 tier 1 and 10 tier 2 cities. The expansion of these centers is going to be across our portfolio. As I said, 45 total. So the 12, will happen. 90% of our portfolio today is in tier 1 cities. 10% is in tier 2. The split of these 45 or the subset of these 12 will happen across, these tier 1 and tier 2 cities.
Okay, understood that too. Now, apart from this, I also wanted to get an understanding of the market share that you hold, sir. Would you have a clarity as to what it is right now and where do you see yourself maybe long term, 3 to 5 years down the line?
So, Sakshi, I don't have those specifics to be very honest. As I mentioned, with 169 centers live, 16 cities, 52 micro markets, we are the number one in the country across these categories. As I mentioned on our model, the managed aggregation model, we believe at this scale, there's nobody else probably in the world that does it. Our demand ecosystem today, 55% is more than 100 seats, 45% is less than 100 seats. I think majority of our competitors look at only 100 seats or more. We are very, very focused on less than 100 seat demand, which is about half of our business. As an integrated platform where we offer all services related to workplace under, I think, very unique in the marketplace. And I think, as I mentioned, all our facility management is in-house today. As a result, we have the highest net promoter score in the country of 70%.
Okay, well, thank you so much Amit, for being with us on this very special edition and sharing with us all the insights that you could for all our viewers. All the very best for the IPO as well as the listing going forward. And we shall have you back on Business Today, more to discuss and to detail for all our viewers what is the vision and the growth plan going forward from here from the company. Thank you so much.
Thank you, Sakshi. Thank you for having me over.
Thank you. With that, viewers, we wrap up this very special conversation as far as Awfis Space Solutions IPO is concerned. You did hear from the management as to what is the plan going forward from here, and also to really understand which way is the company really progressing in terms of expansion going forward from here too. I hope that's given a lot of clarity to you in case you were mulling to still invest in this IPO. Many thanks for joining us, but do stay tuned as the action will continue to follow on your screens on Business Today television.